You think empires are built by making every single division profitable. But the uncomfortable truth is that titans use high-margin cash cows to quietly bury the catastrophic losses of their most vicious asymmetric bets. They mask the financial bleeding so completely that competitors never see the death blow coming, just as Microsoft camouflaged over $100 billion in Xbox hardware burn from Wall Street. If you do not understand internal transfer pricing and balance sheet camouflage, your business is just a collection of fragile targets waiting to be exposed. You operate under the naive, amateur belief that successful megacorporations demand standalone profitability from every product line. You assume they look at a product, see that it loses money, and immediately kill it to protect their margins. You are infected with the builder trap. You sit alone, perfecting your software, desperately trying to make one isolated product cash flow positive, while the capital class builds structures designed to bleed cash legally. By the end of this lesson, you will master the architecture of cross-subsidization. You will learn exactly how to use an 80% gross margin cash cow to fund, camouflage, and sustain a capital-intensive, high-risk bet without destroying your aggregate valuation. This is how you buy a monopoly over a distribution channel, paid for by the profits of your past victories. Step 1. The architecture of camouflage. You never expose a high-burn strategic asset to the open market. If you let Wall Street or your competitors see exactly how much cash your new bet is destroying, they will short your stock and starve you of capital. Instead, you embed it inside a holding company, structure, an umbrella entity that owns other companies, but does not produce anything itself. Here, its brutal capital expenditures are blended with the extreme free cash flow of an established software or IP division. By presenting consolidated financial statements, the master ledger that adds up all your subsidiaries into one single public number, the parent company absorbs the hit. The aggregate margin compresses slightly, but the absolute EPS earnings per share, the pure profit divided by your total shares, continues to grow. This keeps Wall Street and short sellers blind to the localized bleeding. They only see the rising tide of the aggregate. Look at the launch of the original Xbox. It was a financial bloodbath. Microsoft was losing billions trying to break into the hardware market against entrenched monopolies. If they had spun Xbox out as a standalone company, it would have been starved of capital, shorted to death, and bankrupt within 24 months. Instead, Steve Ballmer and Bill Gates buried the hardware division's catastrophic financials deep inside the broader home and entertainment segment of their filings. They masked the $4 billion hardware burn with the highly profitable consumer software sales of Windows and Office. Analysts saw a slight dip in overall margins, but the aggregate cash flow was so immense that nobody panicked. The camouflage held, the money kept flowing, and the bet stayed alive. Step 2. Internal transfer pricing and IP licensing. You control the narrative by controlling how money moves between your own entities. You do not just hand cash from your cash cow to your bleeding division. You structure it. The cash cow division charges the bleeding hardware division internal royalties, continuous fees paid for the right to use intellectual property. This is transfer pricing, the exact price one division of your company legally charges another division for a service, moving cash across your own chessboard. Microsoft did not just give the Xbox division the Windows kernel and DirectX graphics software. Internal accounting dictates that the hardware division must license this IP from the software division, paying internal fees of 5 to 15%. Why do this? It legally shifts the hardware division's remaining cash back to the profitable division. The hardware division now shows massive operational losses in high-tax jurisdictions, meaning it owes the government absolute zero. Meanwhile, the IP is owned by a subsidiary in a favorable tax haven like Ireland or Puerto Rico. The profits are parked where the taxmen cannot reach them. The R&D costs of the software division are directly subsidized by the hardware division. This transfer pricing mechanism optimizes the consolidated tax burden, starves the IRS, and makes the software division look like an untouchable genius. You are sitting there perfecting your code, trying to squeeze a margin out of one isolated SaaS product, while the capital class structures their entities to bleed money legally on purpose. Step 3. Predatory subsidization to bleed competitors. Once your camouflage is active and your transfer pricing is set, you weaponize your balance sheet. You intentionally price the new asset at a gross negative margin, selling a product for less than the raw components cost to assemble. You do this to capture market share and violently choke out competitors who do not have a sugar daddy holding company to subsidize them. When the Xbox 360 launched, it suffered a catastrophic failure rate known as the Red Ring of Death. A standalone gaming company facing this would have suffered an instant margin call when the lender forces you to sell everything because your collateral dropped too far. Standalone companies like Sega went bankrupt for less, but Microsoft, they took a $1.15 billion provision in a single quarter without blinking. A provision, a massive chunk of cash, set aside on the balance sheet today to pay for a known disaster tomorrow. The Windows cash cow absorbed the billion-dollar blow instantly. This allowed Xbox to honor every warranty, maintain market dominance, crush Sony's PlayStation 3 launch, and eventually capture a $200 billion gaming ecosystem. Sony's gaming division was bleeding. Microsoft's was bleeding too, but Microsoft had an 85% software gross margin quietly funding the slaughter. This requires a character trait you currently lack: strategic silence and absolute information discipline. The rich never brag about their asymmetric bets while they are bleeding cash. They control the narrative by controlling the numbers. You must build the emotional discipline to watch an experimental division burn millions without panicking. You must shield your operators from external pressure, absorbing the heat yourself at the holding company level. Let your competitors think you are foolish. Let them mock your localized losses. While they are laughing, you are quietly buying the board. Your assignment: you will map your current or future holding company structure today. Identify your highest margin cash cow. Draft a hypothetical internal IP licensing agreement to fund a high-risk, high-reward distribution channel. Calculate the exact margin compression on the parent company and set the maximum acceptable absolute burn limit. Complete this matrix within 24 hours. I know exactly what you are telling yourself right now. You are saying, I am not big enough to worry about transfer pricing, segment reporting, or holding companies yet. I just need to make my first million. That is the builder trap. If you do not structure the vessel to hold the empire before the water rushes in, you will drown in taxes, dilution, and exposed margins the moment you succeed. Dilution when you issue new shares to survive, and your slice of the pie gets permanently smaller. You build the structure now, or you stay a highly taxed amateur forever. Amateurs try to make every dollar look pretty. Empire builders use their profits to fund the slaughter of their competitors in the dark. Next time, why SpaceX going public would destroy it. Subscribe, you do not want to miss it.